Hey, welcome back to Two Super Guys Trade Stocks. This is Dylan.
And I'm Vinny.
And I can't cuss in the first 15 seconds. So the inflation report was doo-doo, not great. All right, we're going to get into it. It's actually a big problem, and there's some hot takes by barons and a previous Obama economic advisor that this is not going to be good. We might actually get a half-point raise. So.
Two Super Guys Trade Stocks.
Okay, I can cuss now. It was shit. It was not good.
Big old steaming pile of doo-doo, huh?
Yeah, well, the YouTube 15-second stupid rule. So, no, it was shit. It's not good. I don't want to spend too much time on what actually happened because most people probably already know. So, yeah, if you want the whole summary, you could read that. Or just January core PCE, which Jerome Powell likes, rose 0.6 monthly instead of 0.4. And yearly from 0.7 instead of 0.3. That was the bad one. That's a big increase year over year. Now there's some peeps are weighing in. This gentleman, who never heard of him, to be honest with you, but I guess he was like an economic advisor for Obama. He basically put out this chart. That could be a lie. I don't even know. It was on Fox News. I've never actually clicked on that before, but the chart looked pretty cool. So I was like, all right. Yeah. But the numbers do add up. Did check that part. So it is kind of a shitty graph. It looks like the hawkishness, which, by the way, if you listen to Jerome Powell's speeches when he talks, at no point is he saying this is going to be easy. But if you read the reports later, it's always like, we could be coming towards into an end. I've never gotten that from him. I don't understand why that keeps happening. But we got some other problems. So there's a Barron's article on why rate hikes aren't going to work as much as in the past, and why this is going to be a drawn-out thing for years to come, and how this is only just the iceberg. This is the tip of the iceberg spear, tip of the ice spearberg. All right. So basically, after the 2008-2009 crisis, households and corporate entities transitioned from variable to fixed rates. Okay, before 2008. 40% of all mortgages were adjustable rate. Okay. Now, all mortgage debt is 70% of all consumer debt. So that's a large chunk. Okay. When the Fed began tightening policy after that crisis, because they increased, rates a bunch in the 2009 crisis after, it's not really traditional to do a variable rate. Most people just do adjusted rates. So a lot of consumers, other than buying food and services, are not being impacted by the actual rate hikes, which is why you see this crazy consumer spending that it doesn't quite match. Now, it's not that simplistic. There's some more variables, right? 19% of school debt and auto loans are also now traditionally fixed. Yes, you can do variable, but most of it is now fixed. Cost of living adjustments. The Social Security benefits also went up 8.7%, and wage growth is making it so customers have a bunch of spending. So you have a unique problem. Yeah. We have a bunch of inflation. They're trying to do as many rate hikes as possible. And unless you are buying a car or buying a house, then you're definitely affected. But everyone else is not as affected as you would think. That makes sense?
It makes sense. I'm interested. I completely understand the argument is saying that most of this stuff is fixed, therefore it's kind of immune a little bit to the federal rate, fund rate change, but it is really designed to cool new demand. Yes. This isn't really designed to inflict pain upon people that already have made these purchases, but it should be cooling their desire to go out and make an addition one, take out that home equity line of credit to like add an addition on, or to go finance a $85,000 pickup truck. That's really where it's supposed to have its effect. That makes sense.
should be cooling demand, but wage growth is also giving people more and more cash. And I think that there should be something. People are dumb. I think we should put that out there too, right? Like credit card debt. I didn't put it in here. I've done it too many times. It's so bad. Okay. So, like for me, I bought my house before this. I have a 3% mortgage rate. I'm never gonna change that. Like I'm just gonna. It hasn't really affected me personally because I don't really spend a lot of money. It's not really a thing for me. But this was. Can you explain what the Fed minutes is?
So Fed minutes
Fix
comes
this.
out like a few weeks after the meeting, and basically it breaks down like what the discussion was. It's an opportunity to get a little bit more granular detail on the kind of the thought process and of different like kind of Fed governors within like the whole kind of discussion group of the FOMC to see what they're thinking about, what they're talking about amongst themselves, and what maybe their next steps are. That came out this week as well.
Yeah. Just to make this easier and not so wordy, pretty much all of them are like definitely at least a 0.25 increase next. Some of them are like, we might even do a half. They're
Mhm.
not outright saying that, but they might be like, okay, we might have to, which is not exactly what people were thinking were going to happen. Let's switch to the chart.
Yeah, I think
Okay.
the lesson really is that inflation has still been kind of stubbornly persistent. You are seeing indeed a little bit of wage growth. It was a little bit less than the actual increase in cost of living, so it's not wages aren't quite keeping up with this increased inflation, but there is still been wage growth. Still have a very tight labor market. You still have actually, although consumer debt or credit card debt hit an all-time high, savings rate actually ticked back up last month, so people are still having enough excess cash that they're able to save a little bit. Um, and consumer spending was indeed up like 3% for the month of January. A pretty big jump from
Yeah.
December, where it was I think 0.7% or something like that off the top of my head.
That would be the point. That's the point of the argument is that it's not curbing new spending. The rate hikes aren't doing it. Now, if we all had adjustable rates, it would definitely curb new spending and old spending and everything. It would mess a lot of things up. It'd be very depressing. Now, last week, I said that we're going to hit the 200 moving average, right? People who watch this channel know the 200 moving average is the shit. We actually did hit it. We came right back down. Like I said, I didn't necessarily think it was going to happen in like 3 days after that video. Dope.
Yeah,
But
fast.
we came down. We hit it. And also on the Qs as well. Oh,
Yeah.
that's
This is
QQJ. Go.
definitely a major question as far as like those of us like to do a little bit of short-term trading. So I'm interested to see what he has to say about this trend at this point.
So this is a tiny, tiny candle on the Qs. A lot of volume, barely moved. Okay? This is a decision point. There was so many shares between like a $4 price range on the Qs and the SPY. By the way, I'll go back to the SPY. Usually when you have that small of a candle, that high of volume, there's a big move coming. Now, we kind of looked at what the options are, right? We could bounce off this 200, retest this 410, 413 level, and chop for 3 months until the next rate hike. Very possible.
Yeah.
Okay. If we drop below this, I would expect it to be violent and to retest this 373 within like a couple weeks, which I
Wow.
know that's a bold claim, right? Yeah. Unlike other channels, we'll leave this up in case I'm wrong. That's fine. I don't give a shit.
There's at least a 50% chance.
Yeah. We could also bounce off this 200, and I don't think it's going to happen after the inflation report, but some people are still thinking all-time highs. I don't see that happening. I think chopping around this for quite some time is possible. The biggest problem I had with that was the amount of volume we had in a tiny candle.
Hmm.
It was more so on the Qs though. This is a very small candle.
Like something we should both look at too, like kind of reminds me of this is that blow off the top rally that people talk about. Like, what really triggers that, and what does a blow off the top rally really look like? Because people are saying that the economic news is bad, we still may get a all time high because of that phenomena. Is the argument I've heard people make. I'm just curious what that's based upon.
So I don't think anyone knows that answer, and if there was a correct answer, everyone would be billionaires, right? Because we would just all follow that. Well, inflation's bad. We had this amount of volume. We had this candle. Everyone go along. Like it's the stock market doesn't give a shit about that. You know, it's. I wish it did. That'd be awesome. Well,
Yeah.
no, everyone can't have $1 billion. That wouldn't work.
That'd be a lot of inflation.
That'd be a lot of inflation. Yeah, yeah. That's where we're going, dude. Yeah, I still have my puts. We'll see what happens. You got anything?
Yeah, so I put in a pretty bearish trade on Tesla this week. Is kind of my put equivalent right there. I sold the 160 170 call credit spread expiring April. So if Tesla would need to come down below 160 by April is where that trade pays out maximum profit. It's a 3-to-1 profit to loss ratio basically too.
Should have done 155.
155. Interesting.
So yeah, anytime you have a gap up, like so, look, we have this has nothing to do with the whole video we're doing, but this is clearly a super strong level. You can see that we nicked it 3 times, and then we have a gap up. So there's been no shares traded. So this is going to be a very strong support right here.
Interesting. All right, guys.
Should have asked me. All right, dudes.
Yeah, it's all good. Let's get to the next one.